Hey there, Investing Iguana fans. Iggy here, back with another deep dive into the world of REITs. Today, we're talking about Mapletree Industrial Trust and the key juicy details from their 14th AGM. I know AGMs can be a snooze fest. But not this one. I've combed through the slides and picked out the most important key points for you. We'll be looking at how Mapletree has been flexing its financial muscles, the clever moves they've been making, and what it all means for you as an investor. Think of this video as your cheat sheet to Mapletree's AGM. I'll break down the numbers, explain the jargon, and give you my 2 cents on what it all means. Slide 1. First up, Mapletree Industrial is showing some serious muscle in their financials. They've got 375.1 million Singapore dollars ready to dish out to unit holders. That's a tasty 5.2% increase from last year. But hold your horses, because the distribution per unit actually dipped a smidge by 1%. It's like getting a bigger slice of K, but the K itself is a tad smaller. Now, let's talk about how they're keeping their tenants happy. In Singapore, they're holding on to 83.4% of their tenants and even managed to bump up rents by 6.7%. That's pretty solid in my book. Over in North America, they're seeing rents climb by 2.5%. Plus, their overall portfolio is now set to keep cash flowing for 4.4 years on average. That's like having a nice, long lease on your favorite hawker stall. Mapletree's been busy shuffling their property deck too. They snagged an Osaka Data Centre for a cool 52 billion Japanese yen. At the same time, they said goodbye to the Tanglin Halt Cluster, pocketing 50.6 million Singapore dollars and scoring an 8.4% premium above its book value. Smart moves, if you ask me. To keep the money flowing, they've been pretty clever. They raised 204.8 million Singapore dollars through a private placement to help fund that Osaka Data Centre. They also issued some fixed-rate notes in both yen and Singapore dollars. It's like they're diversifying their financial menu to cater to different tastes. Slide 2. Let's break down Slide 2. Since MIT hit the market back in October 2010, it's been on a wild ride, and I mean that in the best way possible. We're looking at a total return of 316.6% up to March 2024. That's like turning $1,000 into $4,166. The secret sauce? A mix of capital appreciation, 151.6%, and a hefty distribution yield, 165%. Now, here's where it gets interesting. MIT hasn't just been cruising along, it's been leaving other indices in the dust. While the FTSE Straits Times Index barely budged with a 1.4% gain, and the FTSE ST REITs Index actually dipped by 3.1%, MIT soared by 151.6%. It's like watching a cheetah race against a couple of tortoises. But let's zoom in on the recent past. The year leading up to March 2024 was a bit of a mixed bag. MIT saw a slight dip in capital appreciation, minus 1.3%, but don't let that fool you. It still managed to dish out a tasty 5.7% distribution yield, giving investors a total return of 4.4%. Not too shabby in a choppy market, right? So, what's the takeaway? MIT has shown it's got staying power and can deliver solid returns over the long haul. Slide 3. Let's now look at Slide 3. First up, the good news, Mapletree Industrial's doing pretty well. Their gross revenue and net property income both went up. That's like your salary getting a nice little bump, always a good thing, right? But here's where it gets interesting. The distribution to unit holders grew by 2.7%, which is solid. But hold on, the distribution per unit actually dropped by 1%. Sounds confusing? Let me explain. Imagine you've got a pizza. Last year, you had a smaller pizza but fewer friends to share it with. This year, you've got a bigger pizza, but more friends showed up to the party. That's what happened here. Mapletree issued more units, so while the total distribution pie got bigger, each slice, or unit, got a tiny bit smaller. Why did they do this? Well, they used that extra dough to buy a new data center in Osaka. It's like investing in a bigger oven to make more pizzas in the future. Now, don't let that small dip in distribution per unit worry you. Mapletree's playing the long game here. They're beefing up their portfolio, which could mean tastier returns down the road. Plus, they're getting more cash from their joint ventures, which is always a good sign. It's like having a side hustle that's starting to pay off. Slide 4. Slide 4 shows interesting data. First up, the good news: total assets grew by 1.4% compared to last year. That's like your savings account getting a little fatter. The main reason? They snagged the Osaka Data Centre last September. Think of it as adding a shiny new gadget to your collection. But here's where it gets interesting. The net asset value per unit, that's like the trust's price tag, dropped by 4.9%. Why? Well, it seems their properties took a hit in the fair value department. It's like when your house value dips because the neighborhood's not as hot anymore. Now, what does this mean for us investors? Well, it's a mixed bag. On one hand, the trust is growing its asset base, which could mean more rental income down the road. On the other hand, the drop in net asset value per unit might make some folks nervous. It's like your favorite stock is on sale, but you're not sure if it's a bargain or a warning sign. Slide 5. Looking at Slide 5, the numbers are looking pretty solid. Mapletree's total borrowings are creeping up a bit, from 2,848.4 million Singapore dollars to 2,984.4 million Singapore dollars. But don't panic. This isn't always a bad thing. They're stretching out their debt a tad longer, from 3.7 to 3.8 years, which can be a smart move. It's like extending your mortgage to make payments more manageable. Now, here's where it gets interesting. Their borrowing costs nudged up slightly from 3.1% to 3.2%. In today's market, that's not too shabby. But keep an eye on their interest coverage ratio. It's dipped from 5.0 to 4.6 times. Think of it like this: if their income was a pizza, they used to have 5 slices left after paying interest, now it's 4.6. Still plenty to eat, but worth watching. What really caught my eye was their recent moves. They raised 204.8 million Singapore dollars through a private placement, partly to fund an Osaka Data Centre acquisition. Smart move. Data centers are hot property right now. They also issued some fancy Japanese yen notes and 50 million Singapore dollars in fixed-rate notes. This shows they're actively managing their debt and thinking globally. The cherry on top? They've got a debt headroom of 577.0 million Singapore dollars to 1,033.7 million Singapore dollars. That's like having a hefty credit limit you haven't maxed out. It gives them room to grow or weather storms. Slide 6. Reviewing the data on Slide 6, we've got a slight bump in their assets under management, from 8.8 billion Singapore dollars to 8.9 billion Singapore dollars. It's not a massive leap, but in the real estate game, slow and steady often wins the race. Now, here's where it gets interesting. Data centers are the star of the show, making up over half of their portfolio. Think of it like this: if Mapletree's portfolio was a pizza, data centers would be the extra-large slice that everyone's eyeing. What's really catching my eye is the occupancy rates. They're holding strong across the board, with Singapore and North American portfolios sitting pretty at over 90%. It's like having a full house in poker, a solid hand that investors love to see. The Osaka Data Centre is fully occupied, which is the real estate equivalent of scoring a perfect 10 in gymnastics. Now, let's talk about their property count. They've trimmed down from 141 to 140 properties, but here's the kicker: their net lettable area hasn't budged an inch. It's like they've gone from wearing baggy jeans to tailored slacks, same size, but a more efficient fit. They've even added a property in Japan, showing they're not afraid to expand their horizons. Slide 7. Lastly, let's look at Slide 7. We've got this well-distributed lease expiry profile that's looking pretty solid. The overall portfolio's weighted average lease expiry, WALE, has jumped from 3.9 years to 4.4 years. That's like upgrading from a regular bubble tea to a large more goodness to enjoy. This longer WALE is great news for investors because it means more stable rental income for a longer time. Now, here's where it gets interesting. The Osaka Data Centre is the star player here with a whopping 18.6 years WALE. That's like signing a rental agreement that lasts longer than some marriages. This long-term commitment from tenants in Osaka could be a goldmine for steady cash flow. On the flip side, the Singapore portfolio is holding steady with a slight bump from 2.9 to 3.0 years. It's not breaking any records, but it's still a positive sign in our local market. Looking at the colorful bar chart, we can see that Mapletree has spread its risks nicely across different years. It's like not putting all your eggs in one basket, or in Singapore terms, not betting your whole CPF on one stock. This strategy helps protect against sudden market changes and keeps the rental income flowing smoothly. Phew, that was a lot to take in. But you made it through, and now you're a Mapletree Industrial Trust Pro. Give yourself a pat on the back. To recap, we've seen how Mapletree's been killing it with their financials, snagging new properties, and keeping their tenants happy. They've had some challenges, like the dip in distribution per unit, but overall, they're looking pretty solid. As an investor, it's always important to keep an eye on these AGM updates. They give you a peek behind the curtain and help you make smarter decisions with your hard-earned cash. If you found this video helpful, do me a favor and smash that like button. And if you want more juicy insights like this, subscribe to the Investing Iguana channel. I promise I won't spam you with boring stuff, only the most delicious financial nuggets. Got questions or topics you want me to cover? Drop them in the comments below. I love hearing from you guys, and I'm always happy to help. Until next time, keep investing wisely, and remember, in the world of REITs,